Hello and welcome to this special broadcast. I am Kopano Gumbi and joining me today is the Chief Executive of FirstRand, Alan Pullinger. Alan, thank you so much for joining us today.
Thank you and good afternoon.
Let's just dive straight in.
Yeah.
When we look at the broader macroeconomic environment in South Africa, the finance sector was the only one to deliver positive GDP growth if we look at Q4. How do you think the industry did it?
Yeah, I think there's probably a lag between what you're going to see, say, in the data prints and maybe what you see in the financial services sector. But I guess those two can never disconnect in perpetuity. So maybe there's a little bit of a lag. And certainly what we did in these results is we flagged that we think a slowdown is coming. We're seeing it in our own business. And we are a business that does well when our customers do well. But we are starting to pick up strain on our consumer segments, our retail banking segments. We're picking up strain. We're seeing the strain in sort of the small businesses, SMEs. This is before any of this COVID-19 stuff. Just the macroeconomic strain, load shedding, all of this low growth, low demand. It's been very, very difficult. And so those sort of data points now are showing up in our business. We're really seeing the slowdown. And it's all the way up to corporate stress as well. So it's probably just a lag. But I think the data will start to show it.
You use the words being cautiously optimistic, but when we look at your last 6 months of results, they've been really positive. You've managed to eke out around 5% in earnings growth. How?
Yeah, what we did say is this is the half-year checkpoint, so this is still a sort of an annual race that we're running. So yes, we're at the halfway stage. We've done well in the circumstances. I guess 5% relatively is a decent performance. But what we are saying is we think the next 6 months are going to be uphill for us. And we started really seeing that slowdown at the start of this new calendar year. So January, February have been slow for us. We really are starting to pick up that strain. So I guess what has helped the first half results, that 5%, I guess it's more of what you saw in the previous financial year. So our largest franchise, FNB, still doing well, still gaining customers. We're still seeing that upsell happening from consumer into premium. We're seeing customer volumes, transactions. We saw that cross-sell ratio, how many products per customer, that also ticked up. We saw a generous contribution from our rewards program, which is also sort of playing out. We make the point that rewards really matter in a slow environment. So that's great from that business. And at the same time, included in these results are some give backs to customers. So we launched 2 very competitive transactional accounts. For one, what we call Easy Zero at that sort of entry-level consumer banking, and then also something called Business Zero for those little micro businesses. So there's some kind of fee give backs. There's some response to the competitive environment. There's no doubt that we've had to up our game and sharpen our pencil on lots of our products. And again, that competition forces that. So it's good for the consumer that banks are responding. But at the end of the day, it is tough times for our clients. And so that's driven the results. I mean, a good performance from RMB, as you saw, up 6%. And then Westbank, group only up 1%, but appreciate that's really in a backdrop of declining vehicle sales. So a good result. And then, we diversified into the UK. We bought a bank in the UK. We integrated that with our existing vehicle finance business in the UK. And we think it's a very commendable result from that combined business. Excluding a mark-to-market on a hedge, which they use for hedging interest rate risk, that business was up solidly, both the Motor Nova business and Aldermore. And we think, pleasingly for us, the outlook for the UK is certainly more positive than the outlook for South Africa, sadly. And so that's good diversification, I guess.
Despite Brexit risks, you still feel that way?
Yeah, so I mean, I guess the terms of trade that have to be negotiated around Brexit are still to be done. But the absolute level of anxiety around Brexit, that has reduced, definitely reduced. Yes, okay, they have to negotiate the terms of trade, but at least going into those negotiations, the UK can at least negotiate as one because they have left. And so all of those different factions, listen, they're going to need to come together because now it is about the country and they need to then face off and have those negotiations. And I would imagine the other point is that Europe itself needs the UK And so, you know, I'm sure there's a lot of gnashing of teeth at the end of the day. But the UK is just too important a market for Europe to sort of play hardball. And so let's see how that unfolds.
Just stepping back quickly on the transactional banking, I know the market is not cluttered, but it's become increasingly competitive. So you're not really making your returns on day-to-day transactionals. I know the banks are looking to home loans more and personal loans. Is that space growing for you guys at all?
Yeah, well, so we do look at sort of that whole customer sort of relationship management and make sure that we get returns as a customer as a whole rather than sort of as an individual product. You know, for us, I guess we are a universal bank, so we have a broad range of products, and so the opportunity for us to capture value on in lots of different places, sort of on that whole value chain, exists. I guess what you don't want to be in a very tough environment is a monoline player, where you're very reliant on sort of, you know, one or two propositions. If they do well, that's great, you're going to do well, but if they slow down, there's no diversification to your business. So we have been diversifying a lot. You know, we talk about the build out of our insurance business. That's really going well for FirstRand. And again, we showed the results in these 6 months. So even in a tough market, we were able to grow the contribution from insurance strongly. And then our save and invest strategies, which again, we have a very small market share and we're growing that. So this diversification in tough times really, really matters.
So now you've cautioned, looking forward, you've cautioned that your results might slow down a little bit.
They're going to slow down.
Do you think that a downgrade is likely and that is going to increase the slowdown?
Yeah, so we do think so. It's really just a function of growth slipping away. So one of the slides that we put up in the presentation was just how much we've been behind the curve in terms of GDP really drifting lower. And every time we've updated our house view forecast, you know, we've been behind the curve. So we've never really been able to sort of get in front of this thing. And it's just disappointed, not just us, but also the market. So and it's the pace of that decline has really surprised us. It's really just drifted away. It's fallen away. And this is before we really get back into the real consequences of load shedding. I mean, I think that's still working its way through the economy. It's going to be another big headwind for a lot of consumers, and certainly SME, little micro businesses. It's going to be a big issue there. And then we haven't dealt with this COVID-19, you know, and I can't speak on the medical side of that, but certainly the economic side of it is big, you know. And so when we see, you know, trips being postponed or you know, events being cancelled, you know, meetings not happening, dinners not happening, people not going out, I understand why they're doing that. But if you think back, you must always ask yourself, who's losing money? Because somebody's losing money, you know, and all of these supply chain disruptions. So I think the consequences of that still have to be felt. And so another headwind, probably driving growth even lower.
So convention has it that a banking entity can't have a higher sovereign rating than the state, because the state is assumed to be the most low risk. Now, if we do get downgraded, what does that mean for you as a bank? How have you had to prepare yourselves and gear for that? Yeah,
so you will notice that whenever the rating agencies come out and they give an update on the sovereign rating, within a day they give an update on the rating of all the banks. And your point is exactly right, is that at the end of the day, I suppose the central bank is ultimately the guarantor. In times of absolute distress in an economy, it is only really the central bank that can come to the rescue. So banks in many ways are tied to the hip, if you like, with the nation state. You know, we have this very important sort of relationship. So there's a lot we've had to prepare for. I mean, I guess the one advantage that we've had is this anticipated downgrade by Moodys has been a long time coming. So you can't say we haven't had time to prepare for it. Our foreign balance sheet is very well prepared for it. So
in what way?
We're very conservative around, for example, the funding gap that we run. We run very, very liquid positions. We make sure that our assets and liabilities are matched in terms of tenor. We make sure that any disruption around refinancing over a downgrade period, we've got what we call a survivability period, an FX survivability period of like 18 months. So we make sure we run a very conservative funding structure with respect to our international balance sheet. And that's mainly the piece that would worry us. In terms of the downgrade, because the South African funding system is essentially a closed system, the money has to end up somewhere in South Africa. And although there may be an increase in the professional cost of funding in the system, the funding will still be available. So it's not as if the funding will disappear. So I guess it's less about a rand funding system. It's going to be much more about your foreign balance sheet and how's that structured. So we've prepared for it. We've got some plans in place.
And as you mentioned, there are a lot of external headwinds as well. It's not just this downgrade. We've touched on COVID a bit. You have operations outside of South Africa, in the UK. I'm not sure if you still hold the India operations as well.
Yeah.
So there are a lot of times that your companies within the group interface with clients. How have you had to change the way you operate because of that?
Yeah. So this is, it's amplified in different jurisdictions. I can say, clearly it's a topic that we talk about here in South Africa, but certainly if we move to the UK, this anxiety around COVID-19 is much higher. It's at a much, much higher level. And I suppose they're closer to some of, if you like, those hot zones, of Italy and Europe, and so they're much closer to it. I guess they are also, in many respects, the UK is often a hub for travellers coming in and out, and so it's probably a higher risk jurisdiction than, say, South Africa would be. So all of the stuff that you've heard about in the media, we're doing it in our own business. So we have hand sanitizers, and we are trying to say, okay, there's certain travel to some of these hot zones, not the UK, but for example, Italy. We would say that those would be off limits for our people. We would try and limit other travel as much as possible. We're going to do a lot of video conferencing. All of those tools that we've got in place now, we have to dust off, and we truly have to test them. But I guess there's a fine balance here between keeping the business going and keeping economic activity alive and available, as opposed to sort of panicking and shutting stuff down. Our biggest concern is less about us and our business. It's much more around how our clients are able to manage this COVID-19. So if you're an importer, either of finished goods or components that go into manufacturing, and all of a sudden there's a supply chain disruption and you can't get those components, well, then you can't manufacture. And if you can't manufacture, you can't sell. If you're an exporter and you can't export your goods because demand has fallen away from some of these markets, it's a problem.
So what do you advise in situations like that?
Well, I guess we have to try and forecast as best we can, sort of, when does this issue peak, and then when does it start to moderate, and then I guess over that period, businesses really need to make sure that they can survive over that period. One of the critical things to look at there is liquidity and funding. So firstly, your level of gearing, and have you got access to enough liquidity to sort of get you over a difficult period. If you haven't, listen, I would suggest talking to your bank, and I would probably do it sooner rather than later, just to kind of look at some of these issues. Interestingly, in different markets, the response has been different. So in the United Kingdom, for example, the government has realized that there's going to be stress in that SME business space in the economy. So what the Chancellor has said, he's going to go to Parliament and they're going to ask for funding that they can effectively direct to that sector to make sure that liquidity finds its way to those businesses. Now, in South Africa, we're in a different fiscal position. Much, much more difficult for our government to be able to offer similar intervention measures to help business. And so I guess here we have to fall back on the other providers of financing in the industry, and I guess banks are part of that. So those conversations, I think, need to happen sooner rather than later, and we're going to have to see how we can try and collectively get over this tough period. Yeah.
So the market's been shaking by COVID. Everybody has to make new plans, and then as you think you're getting a handle on it, the oil price plummets with Saudi and Russia fighting. I can't imagine your big corporate clients and your high net worth clients are very happy right now. What do you advise to them? Don't panic, but when you look this side, it's COVID. When you look that side, it's oil. How do you not panic?
I mean, I think things are very fluid. I'm not an expert to talk on sort of commodity markets and oil and all the reasons for it. It's clearly troubling. I mean, I guess it's fear, and markets are probably just uncertain about direction. You know, I mean, I guess that's really at play, and markets, as you know, don't like uncertainty. I can't really give any insight on that. I can't give you direction of travel. I mean, you know, I always come with a belief that, you know, bad times will pass and better times will emerge. I would always suggest not panicking and getting back to basics and look after your own business and look at your own vulnerability, and can you survive over this difficult period? So look at gearing levels, look at your contingency plans. What have you got in place? I don't think this is, I mean, unless you're a trader and you're clearly capitalizing on these market dislocations. But if you're just a business that services clients and manufacturers, I guess you need to look at your own contingency plans, and can you get through these tough times? So that's kind of where that would be my advice. Uninformed advice.
On that note,
Okay.
Alan, thank you so much for your time today. It's always a fascinating discussion. Thank you.
Good. Thank you very much.
That's all we have time for today. Thanks for tuning in. Thanks to the team here in Johannesburg. From me, Kopano Gumbi, it's goodbye.